Welcome back. You're watching The Money Show on ET Now. Well, it's the 2nd of March and we have, about 28 odd days left for our tax planning. Before the year ends, before the fiscal year rather ends, that's the 31st of March 2021, you need to make your tax-saving investments and payments for the year, for the fiscal year 2020-2021, else you will have to pay tax on that. That's provided, of course, that you are not opting for the new regime. But for those opting for the old regime, which means that the government will consider all the investments and deductions that you are making to cut down your tax bill. You need to do that before the 31st of March. Last year, of course, the FM had granted an extension till the 31st of July owing to the difficulties around COVID-19. But this year, it's extremely unlikely that she will do so. So we thought we'll present to you the options on tax-saving investments. One such option is ELSS, or Equity Linked Savings Scheme. There is a lock-in of 3 years here. It's an equity mutual fund. And if you invest in this ELSS kind of equity mutual fund, you get a tax deduction from your total income. One such really great performing ELSS is the Access Long Term Equity Fund. It's being managed by Jinesh Gopani and it's delivered great returns in the last 3 years, which is essentially the lock-in period of 15.3% as per data from Morningstar. So let's introduce on the show the fund manager of this fund, Jinesh Gopani. Jinesh, thank you so much for taking our time and joining us today on The Money Show. So to start with, let's understand the basic advantages, the benefits of investing in ELSS for tax saving, for tax planning, for all of our assessees and taxpayers out there.
So if you really see, the instrument is a 3-year lock-in product. It gives you those tax benefit on a certain sum. Actually, what happens is when you have a lock-in, you are creating a habit for an investor to start investing judiciously, and with the added flavor of taxation benefit, I think it really helps the investor to stay on course and stay invested for a longer period of time. So clearly, it's a long-term product. As you would see, our name of the fund is Access Long-Term Equity Fund. So it was earlier an Access Tax Saver Fund, but when we did our survey, we really thought that why not make it as a quasi private equity product, where an investor can invest with a 3-year view, and at least because of the lock-in, and the fund manager has the ability to invest for a longer period of time, be it a small cap, mid cap, or large cap.
All right. Jinesh, tell us now a bit about the Access Long-Term Equity Fund. Where does it invest? How does it invest? If you could just, talk to our viewers and all your prospective unit holders as well about the fund.
So if you really see the fund, we have now 11 years history of the fund. The simple thought process was how to create wealth for the investor on a steady and consistent basis, and based on our philosophy of getting into a good governed company, all cap strategy, growth as a philosophy, and looking for cash flows and ROE. We really invested into some of these scalable stories over last 11 years. And if you see the numbers, we have been in a position to demonstrate our ability to consistently deliver shareholder or the investor wealth. The idea is to back leaders or to find probable leaders in the Indian listed space. And if you are able to pick up 2 to 3 stories in a year and stay with them with a longer period of time, it really helps creating a lot of wealth for the investors. So the philosophy is very simple. Go for good governed company, look for quality of the business model, scalability of the business model, and ultimately everything boils down to innovation, ROE, and hence futuristic cash flows. The beauty of this product is a multi-cap strategy. So we can invest in large cap, mid cap, and small cap. The best place to make alpha is in a small cap and mid cap, where the longevity is very, very important. And this product with 3-year lock-in really allows us to invest in some of the companies which may be a very small cap when we invested, but now they have become mid cap or the larger mid cap, and has demonstrated the ability of their business model and delivered consistent return. So I think consistency, steadiness of the portfolio, and also the habit for the investor to keep investing with a longer period of time. All this put together is what the Axis long-term equity is all about. And now with 11 years of history and starting from zero to now uh, close to around 27-28,000 crores, it's been a big game changer and a case study for even for Axis Mutual Fund.
Okay. All right, great. Jinesh, yours has been one of the best performing funds in 3 years. I mean, we've taken the time horizon of 3 years because that is the lock-in period. 15% of return, so pretty good. Now, the tendency, of course, of viewers is, to always look backward, hold a mirror really and see that, okay, this fund has done great in the past, so, it seems to be the most likely choice. But talk to our viewers about that, and also what is the secret sauce, the investment strategy that has led these returns, the outlook as well going forward?
So I think first and foremost, I would like to say that please look at investment into any mutual fund schemes, at least with 2 to 3 year view and more than that, because clearly the thought process is to invest in the companies who have different business cycles, but ultimately they come out as a winner in terms of delivering significant wealth to the investor. So near-term ups and downs is part and parcel of the market, is part and parcel of the volatility in the business cycles. But eventually, if you want to make big money, then clearly long-term holding strategy is warranted. And this product really helps, as I said, to have investment with a long-term view. Investors are also locked in for 3 years, and they don't have to see day-to-day NAV. And once after 3 years, if they see the returns, then I think I would say that they would be happy investors, unless and until there is a significant black swan event like COVID crisis in that year. So, and what we have really seen, Mubina, is once investor gets the flavor of what the fund manager is doing, he participates more in the same schemes because he's happy with the way the returns are being generated. So for us, frankly, a return is not only about making money; it is also about managing the risk at any given point of time. So protection of capital as well as protection of return also is very important. One tends to get swayed by the momentum in the market, high beta in the market. But what we have seen over last many years is, at the end of the day, when beta collapses, there is a lot of cuts in the returns, and that is what we don't like. So our portfolio is a relatively a low beta portfolio, but a very high alpha portfolio. But as I said, it's a long-term portfolio, and hence investors really look into this with a longer term view and invest more. So we have seen many investors putting in the form of SIP, or not only coming during the end of the financial year, we have seen investors putting money all throughout. So I think all in all, I would say it really helps to make consistent compounded tax-free returns without looking into the NAVs on a day-to-day basis.
All right. How do you filter stocks then before buying them for the fund? If you could just talk to us that, because we have unfortunately seen, you spoke about black swan events from a more macro perspective, but we have seen that for individual companies as well, DHFL, ILNFS. So how do you, and while they affect debt funds more, how do you see it impacting your equity funds? Or rather, how do you sort of ensure that those kind of events don't affect your funds?
Best thing to do is making less mistakes in the portfolio, and the way to do it is to have a proper research process, investment process, which starts with creating an universe. and based on certain defined parameters what we have internally, we try to filter out stocks as best as possible, which not form the part of the universe itself. So when you have a filtration process at the start itself, it really helps us to take out as many companies as possible which we don't like, or where there is a corporate governance issues, or the sector itself is not that great sector for the shareholders. So that we take it out from the universe, and then when you have an universe, you categorize into large cap, mid cap, and small cap, and then accordingly we do enough due diligence in particular story what we like. So for us, governance plays a very significant role while allowing any company into our universe. And frankly speaking, last 4 years I would say we have been benefiting, and in the sense we call it as a return for governance. So clearly, if you see our portfolio, we have tried to ensure that you don't get caught into wrong governance companies where there is an ESG issue or a promoter issue or a management issue, and just stay on course in terms of what investments you like and what you are doing. So that has really helped us to stay on course. So avoiding mistakes in the portfolio is the most important thing, rather than investing in the portfolio and creating any problem later.
Okay. Now, Jinesh, before I let you go, I want to ask you a question on the outflows that we have been seeing. I know that we've been seeing net outflows in equity mutual funds for some time now. Unit holders have been pressing the redeem button. But in ELSS, usually, from December onwards, we start seeing net inflows. That has not been the case. Why do you think that is? I mean, why do we continue to be in this profit booking mode of sorts?
See, I think there are many reasons to that, and obviously, fortunately, we have not seen a massive outflows. But you are absolutely correct that industry has been witnessing some outflows across the schemes, and I think there are different reasons. And what I can say is it's all about creating liquidity for some uncertain circumstances, or creating liquidity for the businesses, or just taking out money, taking a view that markets are at all-time high. So I think there are many reasons why people would be taking out money from the market. Someone wants to buy a house, he wants capital, he wants to make down payment to the extent of 15-20%, and he might take out money all across the asset class. And if he would have invested in the mutual fund as well, he would be taking out money. So I think last 12 months, if you really see the way markets have been volatile, the way NAVs went down last March and April, and the way the markets have rebounded and the NAVs have come back, I think different people will have different need for their money, and this is what we are witnessing. Also, one more thing what we are witnessing, which might not be a great sign, but that is what it is. Some of the lump sum monies are going away to fund directly in the market, with various schemes available, various online platforms available. So long the investor understands the risk appetite of the market, it is good, but otherwise it can be a double-edged sword. So clearly, I would say volatility in the markets is creating some nervousness among investors. Once market stabilizes, we feel that within a few months you will start seeing again inflows coming back.
All right. Well, Jinesh, it was lovely having you with us. Thanks so much for joining in then today on our edition of Meet Your Fund Manager. Okay, well, we'll take a very short break right here on the show, but be right back with our Spend with TMS segment, where we will be throwing the spotlight on home loans after SBI. It's Kotak as well that's slashing rate, and guess what? It's Advantage Home Loan Borrower. Stay tuned.